So we're joined this evening by Jonathan Weaver, who is from Mon Valley Initiative, who is the guru of all of the housing things that you would want to know about buying a house. He will teach us all about the home buying process this evening. It has lots of great resources to share with us. So Jonathan, please take it away.
Thank you, Katie. That's so kind. I appreciate it. Welcome, everyone. It is Thursday, the 25th of April, and I am a housing counselor. I work for Mon Valley Initiative. I've been there for coming up on 11 years. My background is in mortgage lending. So, what I brought to Mon Valley was an understanding of kind of what happens in the mortgage banking world, what it's like to help people get home loans. So that's kind of what I brought into the position and kind of the stance that I take. So I get to meet by telephone usually people who express interest in being homeowners. So if that's you, I am happy that you're here. Sometimes I'm not trying to talk right to my client. Sometimes I'm talking to a grandma or a parent, and some of that information gets disseminated down to your child, grandchildren, someone you work with, someone you go to church with. So, if you hear something here that's of value to someone else, please share it. And I think that's how we can all rise up as a community to get those things that we want and desire out of life. So I'm going to start with I got a little presentation, of course, that we're going to work off, and we have some questions that were submitted earlier that we'll answer. And let's get that going. Yeah, so I want to start just with a small quote. I don't think buying a home is difficult, but what I do think is it takes a lot of small little steps. So I pulled this quote. It said, often the most significant accomplishments are the result of many small steps taken over time. By consistently taking small actions toward our goals, we can achieve the results that we may want. So um, it's small things repeated over and over, day in, day out. It's fairly boring, but it's just those little things of knowing what's in your checking account, knowing what you're spending, trying to save $1 here, $10 there, pulling all those things over time is what I think helps springboard people into home ownership. And that's the hard part. People say, well, buying a home is hard. Buying a home isn't hard. It's getting to that position where you're able to buy the home. And it's those small sacrifices that we often make in order to do that by giving up maybe things that we're accustomed to buying or places we're accustomed to going and changing some of our behavior that way. So um, I pulled this from a couple years ago, and it's not quite applicable this year, 2024, because it's talking about during refinance booms, lenders, staff are likely to prioritize higher credit clients than people that are on the lower end of the credit side. But I think what's applicable in 2024 is that there is no refinance boom any longer. The mortgage companies, the banks have laid off people. The mortgage industry is one of you're either hiring or firing. And here in 2024, we are constricting as far as staff. So when we talk about staff, it's no longer that they're working on so many loans. It's just there's nobody left to work on these loans. So that's the challenge that we face in 2024 is the contraction of the market. They're laying off of people who are actually going to physically do our work. So these challenges, we can't change them. I don't expect that I can do anything about it, but what I can do is try to help my clients position themselves to be able to get through that process better, how to be a great applicant, complete, thorough, providing the documents that they're going to need in order to help work your loan. So that's one of the challenges that we're facing here in 2024. Interest rates are not seemingly coming down. Inflation, they raised interest rates to try to tame inflation. That's been somewhat successful, not completely. We're still seeing some cost indexes high. So there's no urgency, I think, at this time for the Fed to cut mortgage rates. So I'm of the mindset that we're probably going to see these rates in the sevens for probably the remainder of the year. So that's not going to change. To me, there's no better time to purchase a home than when the one that you want to buy it comes up. So whether the rates are 7% or 3% or 12%, the best time to buy a house is when the one that you want to buy comes on the market. So we need to prepare for that at any time. As I mentioned, my background in mortgage lending, it kind of boiled down to four simple things that I think a mortgage lender is interested in. And if we can address these four things, if we can know as consumers how we stand in those four areas, it gives us the ammunition we need to be great at asking for a home loan. Um, and the first one that any lender is interested in is the house you're buying worth what you're paying for it? And for all of my clients that I'm dealing with, this is something we're not going to worry about just yet. This comes later when you sign an agreement of sale. This is appraiser that you pay the bank to go out. It's around $500. I saw a cost sheet today where it's now $645. So costs for things have increased, but we need to be prepared for that $500-600 request from your lender to go out and put a value to the home. If you're paying $100,000 for a house, we're just trying to find out that it's worth $100,000. If it's less than $100,000, there's some things we can do in order to get around that. If it's higher than 100,000, that's great. You don't get any extra brownie points. It's not like it's a win for the bank, but I do think it's a win for you to buy something for 100 and maybe to praise this for 110. When you sign that paperwork, on paper that your net worth has increased by about $10,000 in that case. So it doesn't get you any brownie points in the lending process, but it does help you with your fiscal bottom line if that would happen to be the case. So collateral is something that we're interested in, and for the most part, I'm a big believer. We don't worry about it until it actually happens. Some of the things, as I mentioned, you're going to sign a sales agreement. There's some changes in the industry I think that you should be aware of in the way that realtors are being paid. There's been some class action lawsuits across the country, still not determined what's going to happen. Up until this point, the seller, if you don't know, pays any realtor in the transaction. So usually there's a listing agent and they get paid from the seller. And there's also a buyer's agent or a selling agent, and they also get paid for through the seller. And that's changing. And I think to some degree it's for the good. For some degree it's for the bad. But now it is going to come down to, the buyer quite possibly is one of the answers. So they haven't figured it all out. There may be some resolutions to this, but as we come into June, July, we're going to start seeing more and more how this is going to be handled. So you as a consumer may have more input on what you pay your agent. Up until this point, it's pretty standard here in Southwestern Pennsylvania. It's 3% that the uh, 3.5% that the agent would be paid. You may have the ability to negotiate that going forward, where maybe you agree to only pay 2% or 1%, depending on the transaction. So that's something to look forward to, and something that's changed here in 2024 and still is not written as how it will end up, but something that I think all buyers in this market should be cognizant of and keeping an eye out on how that's going to work out. The challenge with that is oftentimes buyers don't have the money to pay that. So, we're trying to disseminate in the industry, can the lender lend you that? Can the fee be passed on some other way to get paid for in the event that a buyer is not in the position to pay that? So more to follow on that one. The second thing a lender is going to want to do, and usually the first one that I'm dealing with when I'm sitting down with my clients, is credit. Uh, Obviously, we pull credit. Comes from three reporting agencies: Equifax, TransUnion, and Experian are the big three. Um, and you need to have a credit that meets the guidelines. Um, so typically that's around 620, as you see there. It usually opens up at 620. I was talking with a lender yesterday that was actually, hoping to see more in closer to the high sixes, 700s at his place to get mortgage loans to go through. So we know that some of those are changing. Um, Typically, I like to see that people have 4 accounts. So maybe that's a car loan, a couple credit cards, and maybe a student loan. Maybe it's several credit cards, retail credit cards. But when you have 4 accounts, they're open, they're not closed, they're available for you to use, and they're more than a year old, then usually we're going to see that your credit score is over 620. So just getting a couple things in place. Many clients that I work with, we talk about maybe we need to add a couple more credit cards in order to help broaden that base or to have those four accounts to help reach that credit score goal. You can clearly do it with one account, but it takes more time when it's one account to let that build up to a lendable credit score. A lot of the people I sit with, we're facing challenges. We're trying to get our credit score to that 620 level and higher. And I try to remind people, it's pretty simple. It's a two-step process. We've got to clear out the old negative, what I maybe called red lights, clear out the old things that are existing and add some new things that are positive. So we want to add some green lights in there. And by doing that two-step process, get rid of the old, add some new. Usually will help start working towards that credit score that becomes lendable. Um, if your credit report has three collections and one open loan, the simple way I look at it is that's three negative signs against one positive sign. It's hard for that credit score to go upwards. So if we can reduce the number of negatives, increase some positives. So let's say we clear out two negatives, so we're left with one negative. And we had a couple more positives, we'd have three positives. And then in case like that, we can see credit scores start to increase. And usually it starts slow, and then over time it begins to speed up as we get more and more time in with the an open loan. So um, payoffs, any collections, any charge-offs, paying down loan balances is super important, um, and adding those new loans in there. So um, as a side benefit, there are some benefits to having good credit that maybe people don't think about. And just the simple impact that it has on what you pay for car insurance. Second thing we'll talk about car insurance is trying to pay in 6-month premiums if possible. But your credit score really has a huge impact on what you pay for car insurance. And Jonathan, and people say, Jonathan, this has nothing to do with buying a home, but this has everything to do with buying a home. Because if you're paying $480 a year for car insurance because you have poor credit, and someone else is paying 220 or 2,200, that's $2,600 difference that they have to work with that maybe you don't. So as your credit begins to improve, I encourage people to go shopping, see if they can get a better policy or get a lower policy than the one that they're paying, maybe based on past credit history. So as your credit score improves, might be a good time to look at shopping. And we're going to take that savings and use that savings to invest or get behind your goal of home ownership. So people with better credit pay less. So let's try to move our needles a little bit to that better credit side to help bring our costs down so that we can save more money towards our goal of home ownership. Third thing a lender is going to look for is capacity. So capacity basically measures, what can you afford based on what you earn, and we all have a number attached to us based on what we earn. So the first thing a lender wants to figure out is what do you earn. So are you salary, are you hourly, or commission, are you self-employed? All those things factor in differently on how we calculate what your income is. Do you get Social Security? Do you get child support? How does that work out as far as what your monthly stream of income is? What's your monthly debt? So we just simply pull that from the credit report. Pretty easy to ascertain that. And then we can calculate, what you can afford, and some common ratios, some common mix of what we think is, 29-41. So FHA allows 29%, almost a third of your income, to go towards a monthly mortgage payment. So if you earn $2,000 a month, then your monthly payment is going to be in that 600, 670 kind of level. The 41 represents your new house payment plus bills that we know that you have by way of the credit report. So again, if you make 2,000 a month, we know that you can afford a total of $820 a month for all your debt. So we subtract what debt you have, and then that leaves us with a number that should be for your home payment. So calculating capacity is pretty simple, and something that we do, of course, when we meet with people who are exploring what their potential is for home ownership. Um, Another thing I pulled from a couple years ago, when they were talking about refinancing, and the highlighted area in 2022 in 2020 where the financial institutions were most likely to deny Black applicants because of inadequate or poor credit history. So what that means to me is if with my Black applicants, then we've got to go stronger into credit and strengthening credit and trying to be as strong as possible because we want to reduce that um, ability when they go to apply for a loan. Uh, for low to moderate income applicants of any color, they were denied mainly because they had too much debt. So, that's figuring that ratio. Do you have more car loans, your car loan payment, or your credit loans, student loans? Are they all kind of out of whack and don't allow you to purchase as much as possible? It always kind of breaks my heart that you're driving a new car and that's going to impact whether you can buy the most house possible. So, some of the things that we as applicants we want to be focused on and cognizant of is that where we need to strengthen. I love the idea of an applicant going into a loan application knowing they're going to be approved, that there's no question in their mind, my credit's good, my savings is good, my debt to ratio are great, and the collateral is going to be the only piece we don't really know about, but knowing that we're strong, knowing that we are in a good position to be a homeowner, I think gives us power in the whole process. Lastly, the last thing a lender needs to figure out is, how are we going to pay for these closing costs? So I share with people that roughly it's about 10% of the purchase price. So if you're looking at a $150,000 sales price home, I think you need to be prepared to address a um, $15,000 question, I guess is the way that I phrase it. We need to know where 15,000 is going to come from. And the great news is it doesn't all have to come from you. It can come from a couple different sources. There's some great things happening right now that are opening that up for people. But kind of the big question is, where's $15,000 going to come from? That 10% roughly, and not to dig too deep into the weeds, part of that goes for down payment. So usually about 3% of that is for the down payment requirement. Closing costs, which are the legal expenses, recording fees, title insurance, appraisal, things like that, usually represents about 3 to 4% of that 10%. And then escrow, which is just a fancy French word for savings account. It's a savings account to pay your real estate taxes, your homeowner's insurance, makes up the balance of that 3 or 4% that's left over. Um, those funds can come from savings, so from just simple savings on your part. The seller can assist. We'll dig a little bit deeper on that, on how that can help you. There's occasionally grants available for people. You get a gift. Maybe you have a Aunt Sally, and Aunt Sally's always wanted to see you be a homeowner. If Aunt Sally wanted to give you all $15,000, that would be a solution to where those funds are coming from. You can borrow against an asset. So let's say you have a jet ski, 401k is possible. You can borrow against an asset for that money into a home. Just remember that when you do borrow against something, then that's a loan that's got to be added into your debt to income ratio. Or you could sell an asset. So if you could prove that you have stocks or bonds, gold, motorcycle, car, you could sell an asset in order to raise those funds. Huge one right now is tax refund. So many people spring. That's one of the big reasons why spring is such a springboard into home ownership is tax refunds usually are substantial enough to make that work. Um, any funds to go into home ownership to purchase a home need to be documented. A lot of people have trouble understanding it. Sometimes I have trouble understanding it, but you have to show or prove that these funds are available. So usually that's with a bank statement or two. Usually they're going to want 2 months bank statement. Maybe that's a bank statement showing that your federal income tax deposit was made. If it's Aunt Sally giving you money, then there's a whole process that goes into Aunt Sally proving that she's able to give you those funds. So there's a number of different things that we can talk about as you're thinking about how to move towards and closer to your goal of being a homeowner. A couple programs that I think of that provide assistance for some of that cash question. One is our state program. It's called PHFA. PHFA stands for the Pennsylvania Housing Finance Agency. Most states have a quasi-government finance agency that interest is in homeownership or residences, PHFA is a great partner. They're a great partner for NVI. They're a great partner for banks across the state. And PHFA has helped us build some apartments, so that's always been fantastic. And PHFA builds senior living centers, so that's always an important uh, activity across the state. And then they also have this program with home ownership. So people that apply, people, you the consumer, you don't go to PHFA for a loan. You go to a lender, and that lender deals with PHFA. So you don't directly contact PHFA for that home loan, but you contact a lender, and the lender in turn sells that loan off to PHFA. But one of the small programs that they offer is called KFIT, and KFIT is pretty forward thinking as far as PHFA is concerned. They came up with this a few years ago, and I think it helped answer a great question as far as cash, needing cash to get into a home. And what KFIT's willing to do is lend you 5% of the purchase price, um, and you have no repayment. So there's no payment per month, so it doesn't change your debt to income ratio. And that's a 10-year grant. So you make no payments for 10 years. As long as you stay in the house, you don't have to give any of that money back. There's provisions in there. If you would happen to need to sell your home, you can sell your home and pay a portion of that grant back. It does require a little bit higher credit score. So we talked about 620 being the entry point, 660 for PHFA. So we need a little bit better credit to access or tap into those funds. And I think it's quite doable. If you can get to 620, you can get to 660 quite easily. So the great thing about PHFA is it's available all year long. It's available 12 months a year. So that's such an important thing as we're planning to purchase a home. So you can see here, if PHFA picks up 5%, then you, the buyer, only have to worry about the next 5%. And there's some solutions to that as well. There's another program it opened a couple weeks ago. I was talking, as I mentioned, saw some lenders yesterday, and they were talking about the first front door. It's a matching program. So first front door is different in that if you put in $1,500, they will match it with up to $15,000. So that's pretty huge. And that's a big increase from where first front door was in 2023. Last year it was a $5,000 match. This year they've bumped that up to 15,000. And there are some special programs that actually go higher for low to moderate income people. There's some additional funds that were made available up to 20,000 that they were giving people. So if you invested 1,500, they would match it with 15, possibly 20,000, depending on certain circumstances. Another program where you don't deal with first front door, you deal with a lender who deals with first front door. It's money made available through the Federal Home Loan Bank Board and comes out every spring. You can see the credit score requirements a little bit higher. It's that 660, 680 range, so it's a little bit higher. The I'm gonna say problem, I don't mean problem, but one of the things that we face is that it's for a limited time only, that there is not funding available all the time. It is limited. And actually, the lenders I talked to, it opened maybe a couple Tuesdays ago, and both of the lenders I talked to are probably near the max of what they were able to allocate. So there's a great program, but it gets filled up and gets used up very quickly, and then it will go away until next year. So part of what I share with people is, we plan for that. We position, if we're talking in the fall, then we're positioning ourselves to get ready for the spring when we know that this should open up, when we know that we want to get in line for those funds and use them. But 15,000 is pretty impactful. It can make a big difference in what it takes for you to get into your home. So there are sources out there. I believe Penn Hills at one time has a program. I believe they still do. If you're buying a home in Penn Hills, we see that. And then occasionally, time to time, we see spot programs come up. I know sometime NVI offered some programs, but keep an eye out for other programs that might be available or changing. A couple of the big types of loans that we see is VA. So if anyone out there is a veteran, if you know a veteran, if you work with a veteran, VA to me is kind of the golden ticket. It's only for veterans. So if you're not a veteran, you're not able to access that funding. It provides 100% financing. So that's no down payment. The seller can pay all closing costs. So here's a case where you don't need any money in theory for someone to buy a home. A veteran should can step into a home with no cash out of their pocket. The rules, the underwriting rules are relaxed and kind of interesting. And usually, if it's kind of a coin toss underwriting situation, usually the VA seems to side with the veteran. And I think that's exactly the way that it should go. VA loans perform very well. So there are records, statistics kept on mortgage performance, and VA loans typically do very well as far as performance long term. So second one's a USDA loan. So maybe not for, I'm in the city, our office is in Homestead, for more rural areas, more country, you might want to look at a USDA loan, which I think is a fantastic loan. I think for the Mon Valley, I think Elizabeth, PA and outwards is kind of where that begins to open up. Monongahela, Charleroi, Ross Shaver, those areas should all kind of typically fall into USDA capable or eligible areas. Um, they can finance 100% and they can include some closing costs. So here's another loan that requires little cash out of a buyer's pocket. I'm not going to say no cash, but it's going to require little cash to get into a home like that. 640 credit, they will consider less than 640 as a manual underwrite. So that's actually a person, not a computer doing that. But certainly if you're looking at those more rural areas, I think USDA is a fantastic program to make that possible. Conventional loans is the next kind of loan that's available. It's typically for better credit, so it's usually going to be a 640 credit score or higher. It does have what we call private mortgage insurance. Private mortgage insurance is just a monthly premium. It's a if you put 20% down, so if you put 20,000 down on a $100,000 home, you're not required to carry private mortgage insurance. And that's not typically the people that we meet as first-time home buyers typically don't have those means in order to put down on a home loan. So they have private mortgage insurance, and private mortgage insurance is just an insurance company that tells the lender that in the event of default, that the private mortgage insurance company would pick up some of those costs. So legal expenses, cutting grass, winterizing a home, getting a realtor relisted would all be paid for by the private mortgage insurance company. There's some 3% down options, which are awesome. And the seller can provide 3% assistance in some of those conventional loans. FHA loans, and this is kind of the main loan I've been seeing recently, not just for small loans, but also for larger loans. Credit score usually opens around 620. Um, Offers some subtle benefits. There's some small technical things, 100% gift. So that's a great thing. If your child's going to college and you want to buy them a place to live instead of being in the dorm, it allows that. It allows a co-signer. So it allows someone with stronger credit or stronger income than you to help you purchase your home. And they become a co-signer, co-obligator. So they are just as responsible as you to make that mortgage payment. And it does allow the seller to pay 6%. So 6% towards your closing costs. So when we talk about 10% is typically what we need to be able to address. FHA allows the seller to pick up 6%. That's pretty substantial. Doesn't mean they will accept it. You kind of have to work with your realtor as far as how to package that up as an offer. But I think a smart realtor or smart seller, if someone has good credit, they've got stable income, they can afford this house, they just need a little help with cash. I think it would be in their best interest to go ahead and pay that 6% if it helps them buy their home. I'm a seller. My goal is to sell. And if my realtor brings me someone who can credit qualify, can afford the home, can afford their payments, and just needs help, if I can do it, I'm going to help them so that I can sell and move on to whatever is next. We talked about PMI, so that's private mortgage insurance. Under FHA, they offer mortgage insurance premium, and mortgage insurance premium is the same, although you're paying it to the government, and it never goes away. So on a 30-year loan, you're going to pay mortgage insurance till the end of the term. FHA does, and you hear it from time to time, it says in their guidelines that they will accept lower credit scores down to 580. So anytime I hear that, it kind of makes me crazy because yes, they'll do it for 580, but it's with extenuating circumstance, and extenuating circumstance in my mind is money. If you have money saved, if you have substantial money in an IRA or 401k, if you have stocks or bonds that you're not pulling into this deal, yeah, sure, they would accept a lower credit score. They could accept more risk if there was proof of assets, substantial assets, sitting in the background, not being played in there. So anytime a bank tells you they'll do 580, I always hit them with, well, when's the last time you saw one go through? And most of the time, they can't think of an instance where a 580 credit score goes through. So I think in many times it's just trying to get a hook for people, to get them to call, to get them to try to pre-approve, to get their business. Um, I'm not so sure that it actually works out for you. So again, when I work with my clients, I don't want them to be at 580. I want them to be at least 620, head into that 680 so that we can tap into some of those additional sources of income to use someone else's money instead of your own so that you can remain strong as you go into home ownership. Don't forget the back end costs. Don't forget the other costs that it takes when you buy a home. You've got to move. You've got to clean your apartment. You need a van, food. You got to, do you want a professional moving company? You got to turn on utilities. That costs money. You're going to want to decorate. Everybody wants to new paint and carpet and sofa. So, it's not just the cost to get you into the home. There's going to be other costs. Many lenders, are going to want to see what we call reserves. So reserves are just simply extra money that you have left over, in case. So many times it's a factor of what your payment is. So if your payment is 1,500, they may want to see 2 months of reserves. They may want to see $3,000 left over after your closing, because it doesn't make much sense to wipe someone out as we put them into a home loan. So don't forget those back end costs. Don't forget to have extra money, for reserves in case your lender may need that. And the lower your credit score, the more important those reserves are going to be. People with higher credit score, people with low debt to income ratio, people with um, uh, other assets, reserves become less important when you're underwriting or grading a loan request in those instances. Um, just wrapping up with this part of it, obstacles can't stop you. Jeff Gittimer, who is a sales uh, presentation guy, he does a fantastic job for salespeople. He wrote several books. He's got some videos out there. Obstacles can't stop you. Problems can't stop you. Most of all, other people can't stop you. Only you can stop you. So if this is your goal, I believe in people so much that people amaze me every day on what they're able to and willing to do in order to get their goal or dream. Um, and there's a whole number of psychological things. Should you tell your friends or not tell your friends that you're trying to buy a house? It's interesting. Different things that I read. Sometimes when you tell someone you're going to go buy a house, mentally it affects you, that it kind of makes your brain think you've already been there. So there's some questions on that. Other times people don't want to see you move up. Who do you think you are, moving out of here and moving up to some ritzy neighborhood? So be careful. But there's people in your close circle that can hold you accountable, can keep you moving forward. Um, you know, no one can stop you. Only you can. We had some questions come in earlier uh, that I wrote down here and maybe hit on a couple. Um, First one, and the one that was asked the most was, how much money will I need? So remember, we talked about 10%. So we talked about 10% of the purchase price is just a rough number. We get down to some fine-tuned numbers as you move closer to signing an agreement of sale. Usually, you get pre-approved, and then you tell the lender, "Oh, I'm looking at 123 Main Street," and they can send you what's called a cost sheet. So that would give you more details in how much money it's going to cost. So for those people out there that ask how much does it cost, my simple rule of thumb is 10% of the purchase price is a good benchmark to work to or towards. How good does your credit have to be? So that we've touched on that 580 with extenuating circumstances, 620 is usually kind of where we start to see it. 640 for conventional, 660, 680 for some of those loans that help um, provide money. Uh, Fundamentals of home owning was a question. I wasn't quite sure of that. Well, there's a lot of directions that one can go. Um, I still believe in home ownership It's been a crazy market the past 3 or 4 years. We've seen anything from, where several offers are coming in into a home, um, which made it really tough for people who were asking for assistance. When there were 5 offers, and the first guy is not asking for any help, and you're asking for closing cost assistance, it makes it difficult. So we've seen that, and that's kind of when we saw interest rates go up to try to squash that. Um, Homeownership isn't for everybody. I don't think everyone should be a homeowner, but I do believe in home ownership, and I think for most people, um, it's a great investment. So most people I talk to, um, they're not looking for an investment. They're looking for something to leave their kids. They're looking for some stability in their family, so their children can go to one school district. Um, they want to leave something behind. They want to leave a legacy. So most people, in my experience, aren't doing it for the investment side. They're doing it for, I think, what really matters is family. Stability for family, kids learning better, study after study on kids learning better, having stable address. So, how much can I expect a seller to come down? Case by case, and that's the interesting thing about purchasing a home. Um, that kind of comes in after me is every deal is different. Um, you're different, your realtor's different, seller's different, the seller's agents, everyone's different. You might look at one home, and the seller may come down a couple grand, and go to another home, and the seller may come down 20 grand. So eh, every deal is kind of its own thing. So I don't know what you can expect. I do know that if you are asking for assistance, then I don't think you can expect them to come down um, as much. I don't know what that secret number is, but as much. Um, you know, because if I sell you my home for 100,000 and I agree to pay 6%, I agree to pay 6,000. I don't walk away with 100. I walk away with 94,000. So I really had to pay money to get you to purchase my home. So if you could read my mind, you would know what my bottom line is. And unfortunately, we don't get to read people's mind. But I do think you can um, gather facts. Um, Looking at a home as you're viewing it, taking some notes, maybe doing some research on the back. If you walk into a home and it's vacant, that's one story. If you walk into another home and there's kids' toys and playpens and balls and toys strewn about, that tells a different story. The first home might be, maybe it was grandma's home and grandma's passed away, and there's 3 heirs, and they're just expecting to get some money from it. So that's one script. If it's a family with toys and playpens, then maybe they're trying to move up to the next level. So that's a different script. Maybe they've only been there a short period of time. They can't afford to come down in price. They need that money to move on to the next home. Whereas the estate, if you picture that it's an estate or get the sense that someone doesn't live there anymore, you can look up an address. You can look it up on the county website, how long they've been there, and it will tell you um, approximately how long they've lived there, and that can help you begin to print the story of, well, they've been there for 40 years. Well, if someone's lived there 40 years, maybe there's no loan against this property. Maybe it's free and clear. So maybe there's more wiggle room in a case like that. Sometimes the heirs are in California and they think that the house should sell for twice of what we're selling here in the Pittsburgh market. So it's hard to say what someone should come down, but I think you can do your own investigative work, kind of begin to prepare um, your strategy on how you want to approach that purchase. Um, how to purchase abandoned property in the community. That's difficult. Vacant property recovery is out there. It takes time. Um, I think that's a challenge for anyone to go about that way, unless you knew the person that's selling it. And at that point, I don't know that you'd call that abandoned. But if nobody really owns it, then you gotta kind of go through the government agency, the local agency to do that. Um, Receive Section 8 and enrolled in family self-sufficiency. Yeah. So what FHA says is that you can use your Section 8 voucher to help with your mortgage payment. So depending on where you might get your voucher, whether it's through McKees Rocks or McKees Port, you'd want to talk to them. There's some, as any program, I mean, there's guides and uh, rules that go along with it. But maybe your income supports 100,000. Well, if they add in the assistance that you may receive under your Section 8, it might lift you up to 130,000 or 150,000. So yes, if you're in a housing choice vouchers program, we can explore that. It's going to require credit. It's going to require that you're working more than 30 hours a week. It's going to require that you roll in Section 8 because they have to do some inspections, and you may or may not be interested in that. But if you're receiving Section 8, they're doing inspections anyhow. So we might as well let them do that to help you purchase your own home, that you can own a dog, you can paint whatever colors you want and have it as your own place. So what's some good places to look when determining the neighborhood of your intended home is safe and stable? Um, I think you got to go out there. If you're buying a home, I suggest to people you should go to that home you'd like to buy, and then if you go to work, drive to your workplace at the time you would normally be going to work. So if you have to be at work at 8, get to that house at 7 and make your commute from that house to your job and see what that looks like. And then the reverse, when you're coming home, kind of see what those traffic flows are. If you're going to buy a home, you should go and walk the neighborhood at all hours of the day. Do you feel comfortable at night walking around this house that you want to buy? If you don't, then that might tell you that maybe this isn't the perfect match for you. So I think, determining the neighborhood you want to be, I think you just gotta delve into it. If you don't know it, um, get out there and try to learn what you can. Maybe there's some Facebook community groups. I live in the South Side. My wife is a part of a couple South Side community groups. So maybe that home that in the neighborhood that you want to go, maybe they have a group like that you can join and kind of get a sense of what's going on, and maybe ask some people there in the neighborhood uh, what their experience has been like. Um, Minimum annual income to buy a 3-bedroom home. That's a great question, but I don't know how to answer that one because we don't know how much a 3-bedroom home is. And uh, but homes nowadays are in many areas are pushing over 100 easily. It's pretty rare to see something lower than that would be satisfactory for most people. So I think that's going to be, an income in the 30, 40, $50,000 range to get started. So I don't know that it's so much the income. Oftentimes what I see is the debt. If you have a $600 car payment and you're making 50,000 a year, that's pretty substantial. That's taking a chunk of what you can afford away from you, taking it away from, and throw a couple credit cards, maybe a student loan on there. So I don't know that it's always the income. I do think it's what we can control more is what am I spending, what's going out the door. So I can't go to my boss and ask for a raise, or at least I don't feel comfortable at this point doing that. But what I can do is position myself to be in a better place to qualify, to pay down debt, to be able to qualify for more on my own behalf. We always have to watch and calculate, pre-approvals. Most people, when to look at homes for a realtor to show you homes, usually they're going to want to have a pre-approval, which I think is the absolute right answer for them. Before, when a realtor is a commission employee, um, I don't want to drive someone around that can't afford to buy a home. So a pre-approval is a pretty quick way to figure that out if someone is at least eligible to buy a home. Um, Having that pre-approval kind of allows you to begin to look at different places that you like. But as you're doing that, I want you to consider real estate taxes has become um, a real factor in affording home ownership. Homeowners insurance. I was talking with the homeowners insurance agent yesterday, and she's saying, base quotes are about $100 a month. So if you get a pre-approval and they're quoting you $50 a month for homeowners insurance, I don't think that's adequate. So costs have gone up considerably here in my own experience with homeowners, as in car insurance as well. But um, taxes usually aren't going to stay the same from what the seller is showing you. So we need to anticipate that. We need to be aware of that, and we need to at least be prepared for a change if those would happen to go up. And part of that story, like I mentioned, as you're exploring a house, you're doing your due diligence on a house, is, if they bought it 50 years ago, then you've got to understand that those taxes are probably a 50-year-old evaluation. If you bought it from someone who bought it 3 or 4 years ago, then you'd say, yeah, those taxes are probably closer to what I'm going to experience, because the evaluation on that one um, might be fresher. If you're buying it from a flipper, if a flipper bought it for 20 and now he's selling it to you for 200, you've got to realize that that's got to be taken into account when your taxes begin to come due. And we have three taxes that we pay when we own homes. We have county, school, and local. County being your lowest, school being your highest. So we want to take into account all those and educate ourselves the best that we can. There's some estimators out there that will estimate, if you put in the sales price of your home, what community it's in. There's some programs out there on the computer that will estimate those for you. I think that's certainly something that I would advise anyone to do that's getting ready to sign a sales agreement. So at least you can get maybe an idea of what they could be. Doesn't mean that that's what they will be, but give you an idea of what they may be. So I see a couple questions here, and we're running close to 7 o'clock already. It flies by. Sure. Okay. Let's. If anyone has anything else that they wanted to ask, that's puts me at the end of my presentation. Um, you know, I'm a big believer. As you're buying a home, I want you to build a team around you. Um, I think you need to have a realtor, a lender potentially, a home inspector, and maybe a housing counselor. Whether that's me at the Mon Valley Initiative or whether you have someone else that you want to work with, I think it's important to assemble a team that you feel comfortable working with. So um, if it's not me, then there's certainly some great agencies in and around the city that are um, that are teaching and sharing classes. I know Dollar Bank has Mortgages for Mothers, which is a fantastic program. I think their program's coming up here in May, so investigate that. I love people learning. I love that you go to a presentation, you may know 90% of what you're seeing, but it's that 10% that I think really gives you the edge, learning something new. I've always said the system's unfair. Everybody knows more than the buyer. The sellers lived in a home, the realtor sold some homes, the mortgage guy has hopefully done some deals. The only person that hasn't been through it is the buyer. So I'm always trying to educate. How can we educate ourselves um, so that we're not the person that knows the least in the room, because that's how people are taken advantage of, and we want to protect ourselves the best that we can. We can't protect ourselves from everything, but we do want to reduce that risk. Um, of something happening that we weren't prepared for. So you can always reach me. I'm a one-man shop. I answer my phone. I do my data collection. I meet with clients. I do my data entry myself. So you can either call me through Mon Valley Initiative. It's 412-464-4000. My extension is 4008. So that's 412-464-4000. My extension is 4008. I'm not in the office that often. I travel a bit. I work from home a bit and in the office a couple of days a week. Or you could email me if that's simpler for you. It's J for Jonathan Weaver, WEAV like Victor ER, at Mon Valley Initiative.com. So it's jweaver at monvalleyinitiative.com. But I'm always open to talking with people, sitting down, helping you see, kind of hold the mirror up to what, where you are positioned, and where we can get some easy gains. So
Jonathan, there was a question in the chat if you could repeat the percentages from your capacity slide.
yeah, so simplest one is FHA. It's 29 and 41. So 29% represents what you can afford for a total mortgage payment. So a total mortgage payment is principal, interest, real estate tax, and insurance. So 29% of your income uh, should go towards of your gross income. So it's before taxes uh, for your home affordability. And then 41% represents your new loan payment plus debts that you already have. So when I work with people, we kind of go in backwards. We figure out what's the monthly income, what's the gross income times 41%, and then subtract out what we know you have, and then compare that number to the 29 number. And we go with the lower of the two. So if you had no debt, then you could afford the full 29%. If you got a little debt, then you still could afford 29. And if you got a lot of debt, then that's going to change what you can afford for a monthly mortgage payment. So uh, sometimes we strategize on how to retire some of that debt to maximize what we can afford. So uh, yeah, so it's 29 and 41 is the simple one. Um, and I think for many people, FHA is still kind of the standard. And those are guidelines. Those are I liken those to lines on a road. They tell you where you should be, but it doesn't hold you on the road. You can get outside of those lines if you have better credit. Your lender might push you up a little bit and say you could do 33, 45. Um, so yeah, they're guidelines. They're not hard, fast rules, and everybody's at kind of in a different place. So if you have lower credit, they may not feel comfortable doing that 41%. So credit really kind of your entree into flexibility, approvability, getting that score up high, I think is so imperative.